Welcome to Fear and Greed, Australia's leading business podcast. I'm Sean Aylmer. High-profile European real estate investment manager, Praemia REIM, has recently partnered with Sodor Capital to distribute its investment strategies to Australian high net worth and institutional investors. It opens up European long-term collective real estate investments to local investors, and the timing couldn't have been better given the just signed free trade deal between the European Union and Australia. Guy-Young Lemay is Head of Research and Strategy at Praemia REIM. Guy-Young, welcome to Fear and Greed.
Thank you. Thanks for having me, Sean.
Can you start off by giving me a quick overview of real estate investing at Praemia REIM? Like, what's your role, where you invest, how you position yourselves in that investment landscape?
Sure. Praemia REIM is a French investment and asset management company with AUM in Europe of 33 billion euros. We have capital coming from retail, through dedicated vehicles, and institutional, so insurance companies, pension funds, as well as banks. We have headquarters in Paris and local teams as well in Germany, London, Luxembourg, Spain, and Italy. I'm head of research and strategy based in Paris. I sit in the European ExCom, and in my role, I look at what's happening in the macroeconomic environment and property market trends in order to guide and support our investment strategies and new product developments. The one thing which is very peculiar for Praemia is our very large concentration on healthcare real estate. So out of the 33 billion euros, two-thirds are allocated to what we call alternative real estates, namely healthcare, hospitality, residential, but also education, and the remaining is office and retail. We have a very strong conviction on the healthcare. We've been investing there since 2012. We have a dedicated team of roughly more than 100 people, 700 assets, and we do have very strong relationships with all large operators in healthcare.
Why healthcare? What is it that attracts you to healthcare real estate?
So healthcare is really a sector which is driven by demographics. It's interesting because when you're looking at the property market across all sectors, and in Europe, starting with what we call traditional office and retail, they prove to be quite cyclical, and demand can be affected by macro shocks. Demographic is something where demand cannot find an alternative. You can stop aging. You need to have to find a place to live. This is not negotiable, and this is something which is really coming to the essential need of living. So healthcare, with people aging across Europe, particularly in Western developed Europe, that aging population need to find a place where to get care. What we're seeing in Europe is the supply gap. Most of the stock has been, built very long time ago and need to be renovated, refurbished in order to meet the current demand. With aging population where birth rates is decreasing and therefore the dependency ratio has been increasing a lot. It's not that easy to build new supply. You need really specific authorization. There is a lot of regulation around it. And therefore, that supply gap, the public sector cannot provide it. So I think there is a great opportunity for private stake to come in and meet that demand.
Just take a step back for a moment, Guy-Young. The European real estate market, you have described it, or Praemia REIM have described it at a turning point. Explain what that is, what the outlook is, why it is at a turning point, broader than just healthcare.
Yes, certainly. Yeah. So over the last 2 years or so, what we've seen is a substantial repricing in terms of European property market, particularly driven by outward yield shift. So it was really driven by interest rate shift. End of last year, we saw a number of key indicators. First of all, economic growth resilience. It's been actually better than what we could fear, and it's been stabilizing. And we had a lot of leading indicators, such as the consumer or business confidence surveys, showing some improvement. The second point is with that repricing going on, particularly, as I was saying, driven by the increase of property yields, we've seen for several quarters in a row those yields stabilizing at a peak level. In historical terms, they proved to become a very attractive entry pricing point and stabilizing. Without yield stabilization, what we saw also in the transaction activity is the bid-ask spread reducing and therefore providing greater pricing clarity to investors. And we've seen that in the acceleration of activity during the second half of 2025 and large deals above 100 million euros happening and being signed. So based on those indicators, we assume the new cycle was starting as the downside was largely absorbed. Now, what we also emphasized on, we're not expecting a V-shaped recovery. It was expected, and it is still expected to be very gradual, but also very fragile, because I cannot not talk about what's happening in the Middle East with the current Iran war. And it is another stress test for Europe. We're all in a wait and see. And it all also goes for central banks. They're currently still holding their interest rates. So there are a lot of unknowns, but what we know for sure is that the longer the conflict will last and the bigger the potential implications will be for Europe in particular, but also for the globe. Now, even this clearly adds risk and uncertainty. It doesn't change the structural foundations of our core investment convictions.
Okay, I suppose my immediate question after that then is why Europe as opposed to Asia or North America, South America, other parts of the world? Why Europe?
So I would say in global scale, what I've seen is that all the markets are moving into a very gradual recovery phase, but Europe in particular has been much steeper in the price correction. Again, as I was saying, essentially driven by that substantial increase in property yields. So in historical terms, Europe would offer relative value opportunity to global investors. The second point when looking at other regions as well is there is something about the supply constrained situation that Europe starts this new phase. There are a lot of regulations, constraints, around the construction. And if I'm looking over the past, I would say since post-COVID up to now, the new supply development has been decelerating a lot. So we're starting this new phase of cycle with very, very much reduced supply situation. And I think the third and last point is really the ESG foundation. I think in Europe, it's much more regulated, much more structural now with the EU taxonomy that defines what's actually environmentally sustainable and what's not. It does provide the same language to all players in the market, being the investors, the companies, but also the bankers. So in other words, ESG is repricing assets. It affects access to debt, to exit strategies. I would say that, for instance, in the US, you don't have that homogeneous regulation around ESG. It's more principle-based. It's more a matter of a reputational risk. I think in Europe, it's much more embedded in its regulatory, and it is really a legal risk. So I would say that's how Europe would differ from other regions. And therefore, although it is more restrictive, I would say, in terms of regulation, it is also providing a clearer view in terms of potential regulation risk on that front.
Okay, so I kind of understand why I'd be interested in real estate in Europe. And we have discussed healthcare, and there's some great reasons for that. What about outside healthcare? What other sectors do you think show promise in Europe in property?
So I would segment three types of sectors, three groups, I would say. So there is one which is fascinating, and obviously it is the most challenging today. It's what we call traditional retail. and office asset classes. We've seen that, with the rise of online retail growth, the rise of remote work growth, affecting the way people used to shop or people want their workplace to be. And one of the key consequences of all of it is there has been a greater degree of polarization within each of those two sectors. So the prime end of the market, which is actually the best-in-class assets, those that are ticking all the boxes, great quality, very well located, centralized locations, greater amenities or services. That segment has proven to be very resilient, whereas outside of it, where actually assets are really suffering, and there is a strong need of either revamping, retrofitting, renovating, and there is. When we talk about that crisis and disruption, it doesn't mean this is the end of that sector. It just does mean that there is evolution in it. So I find those two sectors that were actually maybe the most struggling so far are also evolving and need to be considered. The second group of market is the one I would label solid markets, logistics, hospitality. Logistics has been one of the biggest winners I would say, over the last decade. First of all, the product has become much more understood, much better understood, greater degree of sophistication, standardization, a lot of liquidity going there. It was obviously driven by secular trends such as, the nearshoring strategies, those global trade tensions, and the rise of online retail. Did you know that, for instance, when you have online retailing, that demand, the need of requiring storage space 3 times bigger than any of the standard logistics. So you can imagine the demand growth. It was substantial. Yeah. Value growth in that space was driven by a combination of not only yield compression, we're talking about a yield pricing of 8% before that, down to 5% today, and rental growth. Hospitality is another sector post-COVID that rebounded very, very strongly, and you can imagine why, because everybody was locked down. The performance was great, but now what we're saying is actually because it does show some volatility in it. Now, where the yields have moved up much more than, for instance, healthcare that I was saying, to be the most resilient. And obviously, I will finish on the third group of market, the most resilient. Again, those sectors where demand growth drivers are counter-cyclical. They cannot be affected by economic or financial shocks. Those where you cannot find an alternative for your need. So the living space and the healthcare. Even though very recently, and even looking at the past decade performance, those two sectors stand out in terms of risk-adjusted return basis, which means much more robust return performance as well as lower degree of volatility when compared to other asset classes. So in the living space, I also am looking at the diversity of those space, meaning from senior housing to PRS or student accommodation. This is all driven by the fact that people change the way they want their space. There is a growing mobility, a growing need of more international studies. All of those are making this sector quite resilient, and there is a lot of capital willing to deploy in there still. And healthcare, again, it's quite an emerging because if we look at the European transaction volumes, for instance, it has, in the recent past increased a lot, but it's still, averages 10 to 11 billion euros per annum, which is less than 5% of the total trade activity. So it's still emerging, but I think that because it is so much tied to government policy priorities and everything, and across Europe, that public funding in healthcare costs account for around 70 to 85% in France or Germany, which is way more than in the US. So huge. It does actually give you or provide some revenue resilience. So these two sectors are what I would say the most resilient in the past, today, but also for the future.
Okay, so to wrap it up, looking ahead a couple of years, what's the one strategic insight you'd encourage investors to think about as the European market continues to evolve?
If I would summarize, we come from a period of time where we had quite, it's very easy for me to say now, but we saw that with the low interest rates environment, it was quite easy to create value without actually doing very little. That actually forged, and as well, some passive asset management. The way now moving forward with the higher rates environment is the performance will be driven not only by the income growth, which means income growth, you need to really be much more operational to make people want to be it in the office space or in other kind of space, retail, healthcare, and so on. So my one insight, I would say, is returns won't come for free. Don't wait for the cycle to turn. And I believe next cycle's performance will be driven by asset level relevance.
Guy Young, thanks for talking to Fear and Greed.
Thank you very much.
You've been listening to Guy Young Lame, Head of Research and Strategy at Praemia REIM. I'm Sean Aylmer. You've been listening to Fear and Greed, Australia's leading business podcast.